Well, used to be 25 years ago. It came from the United States, Japan, and Western Europe, went into emerging markets as foreign direct investment, and there you were. And that was the model that they taught us in school. That's changed, and it's changing rapidly. If you look now at what's happening, GDP per capita growth is strongest in certain very large emerging, or now I would say emerged, markets, the BRIC countries in particular, like China, India, and Brazil, and to a lesser extent Russia. There is outbound capital investment rapidly increasing from these countries. We've been working on transactions where Indian and investors were coming in and investing in rail projects in Mexico, where Chinese investors are buying nationwide utility grids in Brazil. So this will impact the globalization and reinforce the globalization of energy markets. It will not be the case of the North just sending money to the South. And that, I think, is a good thing. Now, the largest volume and fastest growth of all those new capital flows is in this area. It is in energy. It's power. It's clean energy. It's also oil and gas. It's mining and natural resources, transportation, and other infrastructure. Where are we now? Clearly, the last 2 years, 2.5 years, have been very disruptive for capital markets worldwide and for governments, which are all very fiscally constrained. I don't think it's the case that we don't have enough capital or cash, but we certainly don't have enough credit moving into new investments. I think longer term, notwithstanding this recession, as we come out of it and different parts of the world will come out at different rates and in different directions. But I think long-term deal flow to finance new energy infrastructure will continue, and you'll see it going into all of those areas we talked about before. Now, the investment needs are absolutely huge. This slide is probably hard to look at it. The scale on the bottom goes from 0 to $5 trillion. This is as of 2006 forecast. And it breaks down by geography the investments needed, with North America at the bottom. Above that are China and Europe. Those three together are the lion's share of the investment. And China, of course, the major place for new investment in energy other than the OECD countries. And then trailing off toward the top. Actually, I think if you drew this picture again in 5 years, it would look very different. So this prediction is probably not quite right. But if you look at the cumulative energy investment just in raw terms, not by geography, but over the entire world, we're looking at about $26 trillion, more or less. There's a lot of rounding errors in a number as big as $26 trillion over the next 25 years that will be going into energy investment. Power will take up about half of that. Within power, about half will be transmission and distribution. Only the other half will be generation, and that does include renewables as well. Oil and gas will take up about a quarter, and the remaining quarter, about another $6 trillion or so, will be coal and natural gas, non-oil liquids, and biofuels. Skip a couple of slides so I can stay on schedule, or Kimball, you'll be upset at me. And look at how these trends are going to play out in different industries. I think there are certain industries which are especially either helped or hurt by regulation and policy incentives. Renewable power and alternative energy, because of the inherent technology risks and the scalability issues, are certainly one of them. Nuclear power, because of either real or perceived safety concerns, and certainly genuine concerns about nuclear waste. That is an area which certainly is subject to regulation. And of course, if countries like the United States historically has done for the last 25 years disfavor nuclear power, then you won't see it develop in those markets. And then other infrastructure to certain degrees is also impacted. Carbon legislation, if we have a carbon price, international treaties related to global climate change will accelerate this trend, certainly going forward. Now, a third bullet on this slide I want to mention for a moment relates to the different national strategies which you'll see around the world. And here I want to be very clear. This is not somebody from the United States telling other people how to do it, because there are different models that work in different places. And frankly, the variety is also an asset to a degree in a global system. But I would say that in general there has been a trend in many markets to move from direct state ownership of the energy sector or parts of it into more private ownership or at least private participation in energy. If that's done right, it can increase energy efficiency. But it has to be done right. And it can be done wrong and cause huge social, political, and economic problems. So how do you do it right? First, regulatory capacity. You don't need to regulate state-owned enterprises. You do need to regulate private companies, especially if they're in an area which tends toward monopolies, which electricity in particular does. I'd say other parts of the energy sector less so. And what's the point of that regulation? Well, you have to balance economic incentives and the price signals which drive efficiency and productivity from a private market with transparency and consumer protection. And in that case, being mindful of social and economic goals and income disparity becomes that much more important. That's true, by the way, not just in emerging markets. I think that's also going to be true in OECD countries as you look at increasing income disparity there and the political impact that that can have, aside from the social justice aspect of it. What's next to bring it home? We will come out of the recession. Arguably, some parts of the economy, some parts of the world already have. Other parts of the world, especially in Asia, have been relatively immune compared to, say, Western Europe or the United States. I think mainly Asia ex-Japan in that context. Capital scarcity or perceived scarcity because of the credit crunch has caused yields to rise, even though real interest rates, of course, have come way down. But the need for extra equity and less debt basically means the capital costs have gone up for projects, and it's harder to finance them. As we come out of this, you will see capital shift again back to debt from equity, which will have the inverse effect of boosting returns. In all of this, we're seeing market consolidation. In fact, James, I had the pleasure of representing some clients who sold your company 1.1 gigawatts of power capacity in Texas, natural gas-fired capacity, about a month or two ago. Closed that one, and you're seeing more of that. And I think you'll see more consolidation, especially in the renewable space. And a lot of that will be companies coming out of India and China buying companies in Latin America, Europe, and the United States. Slower energy demand has been a hallmark of this recessionary period, but we have to be careful. That's not a drop in demand. It's a reduction in the rate of growth of demand. Energy demand is still increasing. And the fact that it's really the growth rate is pulled back in the OECD countries is offset, more than offset, by demand growth in the rest of the world, which as that develops, given the population, is going to be even more significant. The temporary underinvestment we're seeing right now is creating pent-up demand, I think, for future investment. The stimulus spending, which we're seeing, is now tapering off as a matter of policy generally in the West, and that is also, I think, it will cause a short-term dip, but you'll see that pent-up demand and the inflationary pressures that come with that playing a bigger role probably 5 to 10 years out. In conclusion, a couple of observations. Energy efficiency and clean energy are absolutely needed for sustainable development. That is different. 25 years ago, we would have said energy is needed for development. Now we say efficient energy use are needed for sustainable development. That's a change. But one of the areas for discussion on the global level is, what do we mean by sustainable? Do we mean that everybody in the world gets to park a big SUV guzzling lots of gasoline in their garage in a suburban sprawling tract? I don't think that's the vision of what most people mean by sustainable, even the people who live in those houses with those vehicles. But there's a big political element to defining that, and more work has to be done building a political consensus around it. Increased energy, as I've said, it's both causes higher GDP per capita and higher wealth and wealth distribution. It also results from it. That's self-reinforcing. So you'll see a lot of these trends increasing geometrically. Local, national, and international rules, I think, need to be harmonized to a degree, but still allowing for the benefits of experimentation, trial and error, failure, and regional differentiation. But in any event, this constantly changing political and public policy arena will have impacts, both good and bad, on energy investment. I think in general, economic incentives are more effective than regulatory mandates, but you're going to have both, and they need to be complementary and not work at odds with each other. That's the hard part. If they do that right, then you'll be able to stimulate more private investment, because the private investment will flow to lower risk and higher return projects. and the returns need to be reasonable to protect consumers, but you still need returns to stimulate the investment. And lastly, all of this must be done in the context of geographic divergence and income disparity. Those are big challenges, but these are long-term investments. We are all in the same world. We have to share this small blue planet, and in order to stimulate those long-term investments, you need political stability. Political stability can only come if you're not increasing income disparity and the social ills that can sometimes come with these types of programs. And I'll leave it with that and welcome the questions for you on the panel. Thank you.